Hey everyone, it's Zach from Zach Wealth Files. Welcome back to another explainer. So picture this, it's a random Sunday night, you're just scrolling through your feed and bam, there it is. You see a thumbnail with a guy making a shocked face, there's a huge bright red arrow pointing at a stock chart, and the title is promising you the ultimate guaranteed secret to wealth. You scroll down literally one more row and you see another creator pointing at a totally different asset class. Maybe it's crypto this time or commercial real estate, but they're making the exact same claim. Well, today we are going to dive right into this. Our whole mission here is to make investing and wealth building simple, accurate, and genuinely useful. And that starts with decoding this financial hype. By the time we finish this explainer, you're going to walk away with a concrete, completely emotionless framework to filter out the marketing noise and actually protect your wealth.
Look, if you spend any time consuming financial media, you are constantly bombarded by this specific type of language. The biggest wealth transfer in history. The best opportunity I've seen in 10 years. You've got hundreds of creators pointing at hundreds of mutually exclusive assets, and they are all using this identical, over-the-top framing. But here's the cold, mathematical reality. They can't all be right. I mean, just by the simple laws of probability, the vast majority of these claims are wildly overstated. You have to notice that these urgent phrases, they aren't actually factual descriptions of an investment, they are a marketing strategy. They're deliberately optimized to bypass your logical brain entirely and trigger your evolutionary fear of missing out.
To evaluate any financial claim, you really have to understand why that claim is being made in the first place and how social media algorithms actually operate. This comparison brilliantly illustrates the core problem, which is a massive misalignment of incentives. The algorithms actively reward emotion and hype way over measured, nuanced reality. Just look at the data. If someone posts a heavily caveated, fundamentally sound analysis, saying, a stock looks moderately undervalued but faces macro headwinds, so maybe a 2% position makes sense, that explainer gets a measly 2% click-through rate. Honestly, it puts the viewer to sleep. But if a creator claims a stock is the next Nvidia and that institutions are secretly hiding it from you, that gets a 12% click-through rate. Creators are quite literally financially rewarded for manufacturing panic and excitement, while good, long-term investing requires the exact opposite mindset. And this brings us right to the concepts of scarcity and urgency. Basically, these are psychological triggers that hack your brain's evolutionary hardware to force immediate action. When a creator tells you an opportunity is closing fast, they are artificially manufacturing scarcity just to get you to clip. But here's your reality check. The stock market doesn't work like a limited drop of sneakers. A publicly traded company with a $200 billion market cap has millions of shares available. There is zero real urgency here. The only thing that's truly scarce is the creator's narrative. Remember, your goal is to make a solid, long-term financial decision. Their goal is to maximize emotional arousal, so you click their affiliate link. So even if you know the marketing is hyped up, it's still super easy to get fooled when a creator seems to have this unbeatable history of winning picks. To really understand what's happening, we need to look at something called the base rate. The base rate is essentially the underlying historical probability of an event happening. Historically, extensive academic research, things like the famous SPI-VAA scorecards, consistently prove that highly resourced, Ivy League-educated institutional managers armed with fancy Bloomberg terminals largely fail to beat a simple S&P 500 index fund over a 15-year timeline. Think about that. These are hardcore professionals with massive teams of quantitative analysts, and they still lose out to a dumb, passive index fund. The absolutely crucial point here is this number, 90%. On average, 9 out of 10 of the smartest, most highly resourced professionals in the world cannot consistently pick the best opportunity. So if they can't do it, what do you think is the statistical probability that a random content creator sitting in their guest bedroom with a ring light possesses a magical 90% win rate? The base rate says it's effectively zero.
So why does it look like some of these internet gurus have these flawless portfolios that only go up? Well, let's use a coin flipping analogy to put this into perspective. Imagine 10,000 creators start a channel today, and every single one of them just flips a coin to pick a volatile asset. Pure chance. After year 1, about 5,000 are right. By year 3, random variance leaves us with 1,250. By year 5 of pure random coin flipping, you're left with about 300 creators who have been right every single time. To the audience, these 300 look like absolute, undeniable geniuses with incredible 5-year track records.
But they aren't displaying predictive skill at all. This is a textbook definition of survivorship bias. That's the logical error of only looking at the winners who survived a process and completely ignoring everyone who failed. These perceived geniuses are simply the statistical survivors of a massive invisible graveyard of failed channels that you never even see. When you look at their track record, you are literally just looking at the winner of a giant random coin flipping contest. You have to stop looking at the result of their past picks and start auditing their actual process.
We're shifting gears now from exposing the illusion to giving you the actual tools to audit the process of any financial claim. Here is your framework. Real analysis contains these 5 specific signals. First, checkable math over technical astrology, meaning they use verifiable fundamentals like free cash flow, not just drawing random triangles on a chart. Second, the incentive audit. Who actually gets paid if you take action? Third, the steel-manned bear case. Fourth, falsifiability. And fifth, skin in the game. Like, are they actually willing to show you their exact entry price and how big their position is? Let's take a closer look at the 2 most critical ones on this list.
The single most important signal on that list is the steel-manned bear case. This is the practice of articulating the absolute strongest possible argument against your own investment thesis. A credible analyst is going to spend a significant portion of their explainer, at least 30% of it, explaining exactly how and why they might lose your money. They'll walk you through the macro risks, the regulatory hurdles, the competitive threats. If a creator only ever walks to the upside, if every single dip is a generational buying opportunity and they just dismiss anyone who disagrees as a hater, you aren't in an investment committee. You're in an echo chamber.
And this ties directly into the next signal: falsifiability. A real solid thesis comes with specific, measurable conditions where the investor will admit they were wrong and just sell. Hype, on the other hand, relies on infinite goalpost shifting. If a stock drops 40% and the creator retroactively reframes it as a shakeout of weak hands rather than just admitting their initial thesis broke, well, that's not a prediction, that's a horoscope.
We need to talk about the real-world financial and, honestly, psychological damage that happens when you ignore these signals and buy into the hype. This right here is the tragic cycle of the sunk cost fallacy. Step 1, you buy into the FOMO because a creator sounds supremely confident. Step 2, the asset inevitably drops 30%. Because you bought based on their confidence, you look right back to them for what to do next. Step 3, the guru, needing to maintain their infallible illusion, tells you to buy the dip, so you double down. Step 4, the asset just keeps dropping, but you refuse to sell because selling means admitting a mistake and locking in a really painful loss, so you become a trapped bag holder, sitting on a worthless asset for years while the rest of the market's compound interest is snowballing completely without you.
So, the absolutely critical point is how you defend against this. And it is all about position sizing. This is your ultimate defense mechanism. Position sizing means deciding how much of your total money to put into one idea. If you keep your bet to a safe 2% of your total portfolio, your wealth is protected. If that generational opportunity actually works out, great, that 2% will still compound into massive wealth over a decade. But if it goes to zero, it's just a scratch. It's a tiny tuition fee. It doesn't trap you in the sunk cost fallacy, and most importantly, it doesn't risk your financial ruin. Let's bring this all together. This is the concrete action plan you can literally use this week before you ever open your brokerage up again. It's a cold, repeatable, emotionless framework. Step 1, audit the framing. Recognize those urgent superlatives as attention harvesting tactics, not a sign of asset quality. Step 2, demand the checkable math. Step 3, follow the incentive and acknowledge the creator's underlying bias. Step 4, hunt for the bear. If they won't explain why they might lose money, go find a credible analyst who disagrees with them and listen carefully to that argument. And Step 5, size for failure. Decide in advance what percentage you can afford to lose entirely without fundamentally altering your financial life.
Now, a quick but absolutely crucial reality check here. Everything we discuss on Zach Wealth Files is for general education only. Markets are incredibly complex and totally unpredictable. No filter eliminates risk entirely, and your individual situation should always go through a licensed advisor. But what this framework does do is stop you from blindly funding someone else's marketing budget. It helps you find those genuine analysts doing the quiet, rigorous work. Remember, clarity and trust will always beat short-term excitement. Excitement should come from the clarity.
Ultimately, our real goal here is long-term wealth building, not falling victim to the weekly hype cycle. If this explainer changed how you're going to evaluate the next can't-miss pitch, hit that subscribe button for more actionable frameworks just like this one. Now I want to hear from you. What is the most convincing, best opportunity pitch you've ever personally fallen for, and how did it actually turn out in the end? Let me know in the comments below. I read every single one. Filter out the marketing, protect your wealth, and I'll see you in the next explainer.